How did Intel fall and they cut dividend? Could this have been prevented just by using Market Chameleon dividend stock screener? Is what we're going to find out today. That's the answer to the question. So what do? First of all, you're going to click on the home page. We're going to go over some dividends, dividend increase, dividend payout ratios, and see if the Intel debacle could have been prevented if you are an Intel shareholder. So you're not going to click on trade idea, but just to see what's going on in the market just before the market opens. You're going to click on stocks, okay, and in screeners, you're going to click on stocks. Now this is even a free version, you don't have to be a member, but if you are, 7 days, link in the description below. And we got all those numbers, and in here we're going to click on dividends right here, okay. Let's turn this volume up. So we're going to click on dividends. And in dividends, we're going to start and we're going to search, not by market cap, but I'm going to search by volume. This is what I want to do. Okay, so you're going to click on volume twice. Okay, and then we're supposed to find Intel, which is right here. So before we analyze Intel, we're going to read a quick disclaimer and know that this is not a financial advice. I'm not a financial advisor. This is for education purposes only, entertainment purposes only. My name is Eve, also known as Finance After 40. Let's get started with dividend and the stock screener and Intel. Let's go. So what do we have here? There's also the dividend specific screener, but I'm just going to show you how to get there. You're just going to go to basically stocks and screeners, and if you scroll down you will see the dividend, but that's not the point in here. We are looking for Intel because I want to show you something very specific. Intel right here, price today down from 20 bucks. It was 30 something like a week ago, which is crazy. Super high volume. Now this dividend, they just announced on the earnings a few days ago that they are cutting the dividend. So this dividend doesn't exist. This was in the past. P ratio, okay, but you can see here, first of all, dividend growth 1 year, okay, in the last year we're down 50%, negative 50%. And so that's like one red flag, as they say. Dividend growth for average for the last 33 years, negative 17%, and the payout ratio, which is the key for this one, is 211.2%. This is the key that should have said to you, you know what, maybe Intel is not that, like, maybe there's some problems there, because what does it mean, the payout ratio 211%? That means that whatever they make, whatever they earn every quarter, every year, depends when they pay the dividend, probably quarterly. If this number is like, let's say 100%, that means that they're paying 100% of their income, of their revenue to the shareholders, and that's not healthy. You should see a number that is less. You should see a number around, I don't know, 50, 60%, something like that. But 100% is like, hey, there's no, all the income goes to, sure, you hold the stock, great, but if they give all their profits to the shareholders, they can't grow, they can't invest, they can't do research, they can't expand, they can't do anything. So if you see this number on Intel, 200%, that's even worse. That's like they make, let's say, for example, and I'm just very, very simplifying things in here. Let's say they make $100 profit in a quarter. So what they do with this $100 profit, they give back $200, $211 from eventually that pile of money just ran out. And as of, it doesn't take a day, it takes a couple of years, and eventually that day has come. The chicken came to roost, as they say in Wolf of Wall Street, and 211% is way too much. It's unsustainable, and this is what happened. If you look at other stuff, if we go by, I don't know, let's see, let's click first of all on Intel, and then I'm going to show you other stock just so you can see other stuff. And if you click on the stock itself, and you're going to click on dividend just to see what's up in the dividend That's the number of time has decreased in the decreased dividend the last 3 years. One number of stock increase one, the trailing dividend 2.5%. But you see here, so that's the company Intel yield for the dividend. It went up, it went down, and you even see here the increase year over year 8%, 3%. So this was fine, and then 2023 4 times dividend and negative 50. So they decreased the dividend by 50%, and now they only pay 3 times, and they decreased the dividend by 65%. Basically, there's no more dividend as of now and in the foreseeable future. And you see here this thing also shows you all this stuff. So 2017, everything was fine until Nvidia and AMD. Not Nvidia, more like AMD came into the picture and took a lot of money as a competition. And you see here decrease, it started May 4, 2023. Okay, and the dividend decreased from 36.5 cents to 12.5 cents, a decrease of 65%. Okay, then it just 65% all this year. So every quarter they just drop from 36 cents to 12.5, and then they just stay there and stay there. And even with that 12.5, it was 200% dividend from that's just too much, and that's why they went down dividend wise. The company is still hopefully strong long term, who knows, but the dividend, that should give you basically an idea to avoid this stock or dump it a year ago. A lot of red signs over here that you could have just prevented using Market Chameleon, even the free screener. So let's go back. I want to show you some healthy alternative. Okay, not to buy the specific stock, but healthy dividend alternative. So you're gonna click stocks. Okay, let's see what we got here, and go back to the screen and go back to stocks, and I want to show you other stuff. Let's say Apple and all that. So we got ourselves Apple. You see price 207. I want to see the dividend, so you're gonna click the dividend, try it here and see what we got. Okay, and you see here, there we go, Apple dividend yield, yes, it's low, 0.48%, but the payout ratio is barely 15%. So that means they have more time to grow, they can expand, they're doing all that, and they can still pay dividend at least 3 times what they pay now. But that just, I'm not on the board of directors. We got ourselves also Microsoft. You see here 25%, also good dividend, 0.75, but they can actually pay double than that to 50% and it'll still be okay. Nvidia 2%, very low, but they just started. The yield is 0.04. Google 11%, Facebook 10%. We got Eli and Lilly and Broadcom at 88%, so this is something to consider. 75, it's okay. I mean, it's getting there, but 88, you know, it's something. And you can go over all those pages and see Visa doesn't pay 20. Visa does pay 21%, so that's healthy. IVV doesn't pay. That's the one after that. ExxonMobil 45%, United Health Group 55%, JP Morgan 25, Walmart 35. Those are all healthy ratios. And as you can see, those are companies that have been here forever and plan to be here forever. And the dividend is so far safe because they still have room to grow, expand the company, and grow their dividend to shareholder. Hope this was valuable. Market Chameleon 7 days, link in the description below. I'll see you next time.